Your life insurance policy names a beneficiary. You set it up, you pay your premiums, and you assume your family is protected. But there are 4 specific situations where that payout doesn't go to your family. It goes straight into probate court, subject to delays, creditor claims, and legal fees that can eat a significant chunk of what you left them. Most people with these mistakes have no idea they have them. I want to make sure you're not one of them. How life insurance normally avoids probate. Let's start with how it's supposed to work, because understanding the default makes the exceptions much clearer. When you buy a life insurance policy, you sign a contract with the insurance company. Part of that contract is a beneficiary designation, a form where you name the person or people who will receive the death benefit when you die. That designation is the key to everything. Because a life insurance payout is governed by contract law, not by your will, and not by the probate court, the money moves directly from the insurance company to the named beneficiary. It never becomes part of your estate. The court never touches it. The practical result is speed. While your will goes through probate, a process that can take anywhere from 6 months to 2 years depending on your state, a life insurance claim with a named living beneficiary typically pays out within 14 to 60 days of filing. That speed matters. Your family still has a mortgage, bills, and living expenses while probate drags on. Life insurance is specifically designed to provide liquidity immediately. That's the whole point. But it only works that way if the beneficiary designation is set up correctly. Before we proceed, a quick word on how to actually get this done. Everything in this series comes down to one thing: having the right documents executed correctly. Trust and Will is the platform I recommend for that. They let you create a legally valid state-specific will online in about 20 minutes. No attorney appointment, no blank template guesswork. Plans start under $200. Link is in the description. Now, back to our video. 4 situations where life insurance enters probate. Now for the part most people skip. There are 4 situations where life insurance does not bypass probate. Each one is avoidable. Each one is common. Situation 1. No named beneficiary. If you never filled in the beneficiary form, or if you filled it in but the designation was somehow left blank or invalid, the insurance company has no contractual recipient for the payout, so they pay it to your estate. The moment it enters your estate, it enters probate. It gets treated like any other asset. The court oversees it, creditors can make claims against it, and your family waits. Situation 2. Your beneficiary dies before you, and you name no backup. Most policies let you name both a primary and a contingent beneficiary. The contingent is the backup, the person who receives the payout if the primary beneficiary is not alive to collect it. If you named only one beneficiary, and that person dies before you, the same problem occurs. The insurance company pays to your estate, and the money goes through probate. This is one of the most common unforced errors in estate planning. A husband names his wife as sole beneficiary. She dies first. He never updates the form. When he dies, the payout, which could be hundreds of thousands of dollars, goes through probate instead of directly to the children. Situation 3. You named your estate as the beneficiary. This happens, and it is almost always a mistake. Some people do it thinking it simplifies the process. It does the opposite. When the estate is the beneficiary, the payout goes into probate, becomes available to creditors before your heirs see a dollar, and loses the speed advantage that makes life insurance useful in the first place. Situation 4. Your beneficiary is a minor child. This one surprises a lot of parents. Life insurance companies cannot legally pay a death benefit directly to a minor. If your child is under 18 or 21 in some states, the insurer must hold the funds until a court appoints an adult custodian to manage the money on the child's behalf. That court process can take months. During that time, your child does not have access to the financial support you intended. The court will appoint whoever it sees fit as custodian, which may or may not be the person you would have chosen. And once the child reaches the age of majority, they receive the full amount outright, regardless of whether an 18-year-old managing a large inheritance is something you would have wanted. How to fix all 4. Each of these 4 situations has a straightforward fix. For situations 1 and 2, no beneficiary or no contingent beneficiary, the fix is to log into your policy, pull up the beneficiary designation, and fill it in completely. Name a primary. Name at least one contingent. Use full legal names. Review it after any major life event: marriage, divorce, birth of a child, or the death of a beneficiary. For situation 3, estate named as beneficiary, change it to a person. There is almost never a good reason to route life insurance through probate. If the reason you named your estate was because you weren't sure who to name, that's worth resolving with an estate planning attorney. But a named person is almost always the right answer. For situation 4, minor children, there are 2 good options. The first is to name your spouse or another trusted adult as the primary beneficiary, with the understanding that they will use the money to support the children. Simple, and it works in most intact family situations. The second, and more robust option, is to establish a trust and name the trust as the beneficiary. A trust lets you control how and when the money is distributed. You can specify that funds be used for education, living expenses, or other defined purposes. You can set an age, 25, 30, whatever you decide, at which the child receives the remaining balance outright. The trust receives the payout directly from the insurer, no court intervention required, and the trustee you named manages it according to your instructions. Naming a trust is the professional standard for parents of minor children who want their life insurance to actually function as intended. One bonus reason to keep it out of probate. There's one more reason the beneficiary designation matters that most people don't consider. When life insurance pays directly to a named beneficiary, it is generally protected from your estate's creditors. Your debts cannot reach it. Medical bills, outstanding loans, credit card balances, none of those can be satisfied from a payout that flows directly to a living beneficiary. But the moment that payout enters your estate because there was no beneficiary, or the beneficiary was your estate, it becomes fair game. Creditors are paid before heirs. The payout your family was counting on may be reduced significantly before anyone in your family sees a dollar. Keeping life insurance out of probate is not just about speed. It is also about protecting what you leave behind from what you owe. Here is the summary. Life insurance bypasses probate when you have a named living beneficiary. It enters probate when you don't. The 4 situations to watch for are: no beneficiary named, no contingent beneficiary, estate named as beneficiary, and a minor child named directly. All 4 are fixable in under an hour if you know where your policy is and how to update the form. In the next video, I'm going to show you how the bank account setting that keeps your money out of probate. Most families skip this step by step. It takes about 10 minutes, costs nothing, and is one of the simplest ways to keep money out of probate entirely. If this video helped you understand something you didn't before, hit the like button. It takes 1 second, and it helps this channel reach more families who need this information. And subscribe so you don't miss the next one.